Hey everyone, and welcome. Today, we're going to pull back the curtain on something called alternative investments. Now, this isn't just some obscure corner of the market. This is the actual playbook used by the biggest, smartest investors out there. We're talking giant pension funds, university endowments, the real heavy hitters. So let's dive in and see what they're doing differently. It all really starts with this one simple question. If you ever look at how a massive university endowment invests its money versus how most of us do, the portfolios don't just look a little different, they look like they're from two completely different planets. And the reason why they're so different reveals a whole new way of thinking about risk, reward, and really the entire point of investing in the first place.
And here it is, the core philosophical split. See, traditional investing is all about relative performance. The big question is always, did you beat the S&P 500 this year? If the market's down 20% and you're only down 18%, congratulations, you won. But you also just lost 18% of your money. The alternatives world kind of throws that whole idea out the window and focuses on absolute return. The only goal is to make money, period. Doesn't matter if the market is rocketing up, crashing down, or just going sideways.
So why is just making money so darn hard? Well, the big villain in this story is something called systematic risk. This is the big, scary monster that you can't diversify away in a traditional portfolio. It's the risk that some global crisis hits and everything, I mean everything, goes down at the same time. Even if you own hundreds of different stocks, systematic risk can sink your entire ship.
And this is the perfect picture of how that risk can just spiral out of control. So some kind of shock hits the market. A few investors are forced to sell. Maybe they hit a risk limit. That sudden selling pushes prices down and makes the market more volatile. Well, guess what? That rising volatility now forces other investors to hit their risk limits, and they have to sell too. It's this terrifying feedback loop, a domino effect that can crash an entire market.
Okay, so if all the traditional stuff, stocks, bonds, are all vulnerable to this scary cycle, what's the solution? Well, the answer lies in exploring a whole new territory, the world of alternative investments.
So what in the world is an alternative investment anyway? The simplest and honestly the best definition is just by figuring out what it's not. If it's not a plain vanilla buy and hold investment in public stocks, public bonds, or cash, then boom, it's an alternative. It's really as simple as that.
This map here lays out that whole alternative universe, and it shows a really critical dividing line. On one side, you've got assets that are pretty liquid, meaning you can buy and sell them easily on public markets. Think commodities, maybe some hedge fund strategies. But on the other side, you've got the really illiquid stuff, things rooted in the private economy, like a new airport or a private company. And this distinction between liquid and illiquid, it's absolutely everything.
We can basically sort this whole universe into four big buckets. First, you have real assets. These are tangible things you can actually touch, like office buildings or farmland. Then you've got hedge funds, which are using all sorts of advanced strategies in the public markets. Third is private equity and credit, which is all about buying, fixing up, and lending to companies that aren't on the stock market. And finally, structured products, which are pretty complex, engineered financial tools.
All right, so now that we know what these things are, we've got to talk about the most important part, the mental shift. To really get this world, you have to kind of throw out some of the old rules about risk and reward that you might have learned in Finance 101.
So why do investors even bother with all this complexity? Well, it really boils down to three main goals. First, you're hoping to get excess returns, basically getting paid more for taking on different kinds of risk. Second, you want to hedge against or protect yourself from that big scary market risk we talked about. And third, you're looking for returns that are uncorrelated, meaning they dance to the beat of their own drum and don't just follow the stock market up and down. That's true diversification.
Now, this is a sentence that would probably fail you in a traditional finance class, but in the alternatives world, it's a fundamental truth. Think about it. A private business or a giant infrastructure project isn't priced every second of every day, so it doesn't have daily volatility. But that doesn't mean it's risk-free. Not at all. The risk is just different.
I mean, just look at the VIX, Wall Street's so-called fear index. This chart shows the stock market in black and the VIX in green. See the pattern? The VIX spikes and goes crazy after the market has already fallen off a cliff. It's great at telling you that you just crashed. It's not so great at warning you about the crash that's coming. It's a rearview mirror, not a crystal ball.
So volatility isn't the right way to think about risk here? What is? Well, a really key concept is the liquidity risk premium. All this means is it's the extra return you expect to get paid for locking up your money in something you can't sell tomorrow. It's the compensation you get for giving up that liquidity. Really, it's a reward for being patient.
And this chart just shows it perfectly.
On the far left, you've got super liquid, short-term stuff like cash and bonds. Their expected returns are pretty low. But as you move to the right, towards investments that lock up your money for 5, 10, even more than 12 years, like private equity or infrastructure, that potential return premium you can earn for being illiquid just gets higher and higher.
Okay, so how do the pros actually put all this theory into practice? They don't just dump everything into a big pile. They use structured models. And one of the most common ones is called the engine model.
The model creates two separate parts of the portfolio, like two engines. First, you've got your liquid engine, made up of your normal stocks and bonds, plus some liquid alternatives like hedge funds. This is for your shorter-term needs and has lower return targets. Then, you have your illiquid engine. This is your long-term powerhouse, filled with private equity, real assets, and it's targeting much higher returns over many years.
And here's what that might look like in the real world. A big investor might start with a 70-30 split between public and private markets. But over, say, a 10-year period, as they get more comfortable and some of their old investments pay out, they might slowly crank that up to a 60-40 split, putting more and more capital to work in that higher-returning illiquid engine.
Now, all of this, the higher returns, the diversification, it all sounds amazing. But, and this is a huge but, it comes with a massive catch. This isn't like buying an S&P 500 index fund in 2 clicks. The real price of admission here is knowledge. It's doing your homework.
See, unlike the public markets, which are super regulated and pretty transparent, the world of alternatives can be murky. It can be complex. There are fewer rules, less public info, and that means the responsibility for investigating an investment, that whole process of due diligence, falls 100% on you, the investor.
And good due diligence really has 2 parts. They're like 2 sides of the same coin. On one side, you have strategy risk. You have to ask, is this investment idea actually brilliant, or is it flawed? That's the what. But on the other side, and just as important, is operational risk. Are the people running this thing competent? And more importantly, are they trustworthy? That's the who.
And you couldn't find 2 better cautionary tales than these. First, you have long-term capital management. It was run by Nobel Prize winners. I mean, the strategy was pure genius. It worked perfectly until a once-in-a-lifetime event happened and broke their models. The whole thing blew up. That was a strategy failure. And then you have Bernie Madoff. His strategy was a complete lie, just a basic Ponzi scheme. The failure there wasn't a brilliant strategy gone wrong. It was just a total, complete operational fraud.
And this is the absolute crucial lesson here. A brilliant strategy run by incompetent or dishonest people is going to fail. And an honest, trustworthy team with a deeply flawed strategy is also going to fail. You have to vet both the blueprint and the builders. There are no shortcuts.
And that really leaves us with a final question to think about. As this world of investing gets more and more complicated, where should we put our focus? Is it on finding the most clever, mind-bending strategy out there? Or is it about finding people with absolute integrity and competence? It's the central challenge of navigating this world beyond stocks and bonds. Thanks for joining me.